Hi, everyone. As we let people filter in here, we're going to get started in just a little bit. We'll get started here soon, but we're just going to give some time for people to join. And yeah, very excited for today's webinar. So we'll get started here in a minute. Awesome. So we're going to get started. Yeah. So today we have Drew Wahlgren presenting investing in industrial real estate using IRA-friendly vehicles. And before I turn it over to Drew and let him get started, I do have a quick disclosure I have to run us through. The views expressed by speakers of the CAMA webinars are those of the speakers only and may not reflect those of CAMA, its members, or employees. CAMA does not guarantee the accuracy of information provided by the speakers or attendees. Professional advisors should be consulted before implementing any options presented. CAMA absolutely does not endorse or recommend any individual or organization, including the speakers. CAMA, its members, and employees do not accept liability for losses and/or damages arising from errors or omissions within, reliance upon, or any use of the information provided by the speakers. Individuals are strongly encouraged by CAMA to conduct their own due diligence before making any investment choices. CAMA does not act as nor offer the services of an investment advisor, CPA, realtor, or attorney. If tax, legal, accounting, investment, or other similar expert assistance is required, the services of a competent professional should be sought. And if you find that you have yourself questions for CamaPlan following this presentation, you can feel free to reach out to one of our client executives, Will Mucker. You can email him at engage@camaplan.com, or you can give us a call at our office. And with that, I am going to turn it over to Drew. And yeah, go ahead. I'm looking forward to it.
Sure. Just want a quick screen check. Everything looks good there.
Looks perfect.
Great. Thanks, Michael. Appreciate it. Happy to be here. My name is Drew Wahlgren. I'm with MAG Capital Partners. I'm the VP of Capital Markets here, and I come from a background of investing real estate since 2011. I've been here part of the team, really lining up equity and debt for our commercial real estate investments since 2019. I'm up here in North Texas, right inside Fort Worth, Texas, and had a BS from CSU Hayward, Cal State University School with an option in finance. So come from this background and excited to be here and chat with you guys a little bit and share a little bit more about our team. I'll share a little bit about us and then our investment strategy, and then also really get into how we structure investment vehicles that are a great fit for self-directed IRAs and solo 401ks for those folks listening, assuming all clients here of CamaPlan who are looking to deploy capital into a strong real estate investment vehicle with their retirement funds. So a little bit about us. We're a private commercial real estate investment group that really has a focus on industrial real estate. So as you can see here, there's a map of assets that we own and have owned in the past. We've gone full cycle on 31 investments where we've raised investor capital, made the investment, and exited the investment, returning capital and profits to investors. But today, we own about 950 million in assets, which is this is 88 properties, a little over 90 at this point across the US. And as you can see on that graph below, 70% of this is industrial real estate. So we really have a focus here and a specialty and a niche and a lot of deal flow that comes to us because of that reputation we have in the industry with brokers and private equity groups who are looking for a reliable real estate buyer. So a little about our team here. As you can see, we have a pretty robust team. Those two gentlemen on the top left, Dax Mitchell and Andrew G, are the two co-founders of MAG Capital Partners. They both had decades of commercial real estate experience, then partnered in 2015, thereby founding MAG Capital Partners. And we're fully vertically integrated, meaning we raise capital in-house. We have in-house credit risk advisory staff, as well as construction and facilities management services, all the way down to accounting managing tax forms and distributions to our our investor group. So our thesis is really that we believe in small and medium cap American manufacturing across this country. We feel that these companies are irreplaceable, and so is the real estate that they occupy, as we've seen a lot of growth in the industrial real estate asset class really since about 2010, right after the great financial crisis. We've actually continued to see manufacturing jobs increase in the country, and we've seen increases in logistics for e-commerce, right? As we buy more and more things online, and then we hit 2020, of course, that just skyrocketed as companies were scrambling to get more delivery logistical supply chains to service e-commerce demand. However, a lot of that's been built out and there's continued sort of incremental growth there. But really what we're seeing now beyond that is this trend in onshoring and nearshoring of manufacturing, which is great for the country, a lot of jobs coming here. But it's also has a huge demand on industrial real estate as companies are looking to bring some of the critical pieces of their supply chain back to the US so they can mitigate the risk of bringing in product from around the world. So we've seen a huge amount of demand here outstripping supply as it comes online. And there's been a little bit of a up and down over the last 12 months as a lot of new production comes online, but really forecasted demand continues to be really strong. So just a quick high level view. I mean, this comes from the National Council of Real Estate Investors, showing a few different asset classes. Here you see retail, apartments, industrial, and office. Office, obviously, a big negative trend there. Those three bars are representing 2023, 24, and 25 projected returns in these different asset classes. So this is a really broad high level view, but I just wanted to show this as it really shows the strength in industrial real estate and what economists are seeing there as far as, again, that demand really benefiting investors who are in the space. So a little bit about our investment strategy. What we specialize in are sale leaseback transactions. So typically, I mean, 90% or more of the acquisitions we make of industrial real estate is a sale leaseback acquisition where we're buying the industrial real estate from the owner occupier there, right? So think of a manufacturing company there who's operating there and owns the real estate. And what they're looking to do is sell the real estate, but not move. They want to stay in place. And so simultaneously, as we close on the real estate acquisition, we're also executing this long-term lease, typically 15 to 20 year absolute triple net lease. And so what we get there is this immediate cash flow because there's 100% occupancy there, which is really great. So they're really trading capital, which they're looking to access in return for a rent obligation. So a really frequent question is why do these guys do this, right? Are they in trouble? Do they need the cash? And it's really a financing instrument for corporate manufacturing companies. They're looking to do a number of different things, and it's really case by case. But again, using this as a financing transaction to access that equity tied up in their real estate to grow the company or reposition their balance sheet. Sometimes it's paying down some short-term debt. Sometimes it's just restructuring their debt that they have. They might have a mix of short and long-term debt that they want to pay down, or they may have using this capital to acquire competitor companies. They might be using it to invest in CapEx within their company, launch a new product line, let's say, that needs more manufacturing equipment. So it could be a number of different reasons, but at the end of the day, they're using this transaction to strengthen the company's position. So that lease that I mentioned, we're closing and executing is an absolute triple net lease. You might have heard of triple net leases before. That means that the tenant is responsible for taxes, insurance, and utilities, which is nice. We take that a step further. Really the gold standard for us is an absolute triple net lease, which includes everything fence line to fence line. So we're talking about roof and structure. We're talking about HVAC systems. We're talking about landscaping, the parking lot. Everything is being transferred, those operational expenses are being transferred to the tenants in this case. So for us, we have a lot of insulation from expenses, complete installation from operational expenses at the property. So what that model creates for us is this we have 100% occupancy from day one. We have this cash flow that's beginning right as we close, right? Rent is due immediately. There's no expenses, as I mentioned, in that absolute triple net lease. And we have this long-term commitment, again, usually 20-year leases that we're executing at closing. And using fixed rate financing, we're able to really become very predictable in our cash flow. We know exactly what our mortgage is or debt service. We know what our rent is. We know our expenses are nil. There are none there. And we have these built-in rent increases every year, usually 2.5%, 3% per year, which is a direct increase in net operating income because, again, we don't have expenses. So it's a nice model for predictable cash flow and very strong, which I'll get to. But how we're creating value over the course of the whole period of these properties is we're paying down debt. I mentioned we're using fixed rate debt. That's fully amortized, right? This is really real estate fundamentals investing, right? Hey, pay down the mortgage over time. But we're also increasing that NOI, which is how a function of how commercial properties are valued, right? Looking at net operating income, and we can see that again increasing, an average of 2.5% or so per year, and so thereby increasing the value of the property. We also create some value opportunistically as we see our tenants will say, "Hey, we're growing." That's always a great sign, right? They're really strong businesses ramping up. They're seeing more demand in sales, but they need more space. We will develop expansions on these properties. So we typically target properties with more land around them. That gives us the opportunity to do a build-to-suit expansion so they can, hold more raw materials or have new equipment. Again, a new product line. So it could be a number of different options there, but we'll finance and manage that. We have that development expertise and the staff on hand to manage that. And we actually have one right now that we're doing in our current fund, which I'll get to. But that creates a lot of additional value within that property and a portfolio. So kind of getting to the risk here, I mentioned all of the positives. That's great. We really like to be transparent about what the risk is and how we analyze that and how we mitigate it. There's always risk in any investments, and real estate investments really vary the risk. The linchpins of risk out there. So in this case, we have this, again, no operational risk because we're not managing vacancies. We're not tied to a floating rate loan, which you see a lot of people in trouble with these days with interest rates as high as they are. And so where we have this risk is really concentrated in having a single tenant. So single tenant default risk. What if this company defaults on their lease and goes all the way down to Chapter 7 bankruptcy where the company shuts down? Now, it's a really unlikely scenario, and I'll mention just for context, out of about 95 tenants that we've had and managed properties with, we've only had one ever default on the lease, and we worked through that and had a profitable outcome. But it's very uncommon events out there. So the way we mitigate that, and part of the reason it's been uncommon for us is because we've built our team around this. We have credit analysts in-house, and that's where we spend a lot of time is in due diligence on the front end while we're in contract on the property to really spread the financials of the company, really understand their history, look at really what they're projecting for the future, what kind of headwinds and tailwinds might there be in the industry that they're in, customer concentrations. I mean, I could spend another 30 minutes just on credit analysis, but we do that in-house, and the guys that we brought onto our team, we've hired them from institutional, publicly traded REITs and some of these large firms where they had 10 plus years of experience. So we've really built our company around that and avoided any kind of landmines by doing a lot of due diligence on the front end. So, but behind that, we also have in our leases quarterly financial reporting that we require from the tenants. So we watch them, monitor their performance so we can see if there's blood in the water. But as you see in the bottom part of the slide here, what we're investing in is real estate, right? So we always feel very safe when we have a defensible basis on this real estate, right? I could lose a tenant completely, and that's not an ideal scenario, but I'm still holding real estate. I didn't have a corporate bond that gets washed away in bankruptcy. We still own a hard asset It's industrial real estate, which, as I mentioned, has a lot of demand out there, especially again due to onshoring of a lot of manufacturing. So there's a lot of need for that out there. And as long as we bought correctly and with below market rents, price per foot that's well below replacement costs, that really puts us in a great position to be able to either release the property or sell it to maybe an owner user, like another manufacturing company who wants to own their own assets, or even an investment firm that, or an investor individual who wants to buy that and lease that up. So it gives us a lot of protection there. So I'll get to the actual opportunity here, and then I'll get to kind of how that fits into someone's self-directed IRA or retirement portfolio. But we buy these assets in the same manner that I just described and roll them up into a fund structure. So currently, actually only for about a month and a half or so, we'll be raising capital for MagCP Industrial Fund 2. Now, this is a diversified portfolio of triple net lease industrial real estate across the country. And so this comes off the heel of our first fund. And this is a fund structure. And in the past, before about early 2022, we had been raising capital for these and structuring individual investments. But the fund structure makes a lot of sense here to have 15 to 25 of these properties to mitigate that risk and diversify that risk. If we do have a single tenant default, we have numerous other properties that are performing that can continue to support debt and the mortgage payments, as well as continue to distribute cash flow to our investment group. So Fund 2, we have a 6-year hold horizon that we're targeting. We're about 12 months in. So there's about 5 years left on this targeted hold period. We're targeting a 15 to 17% IRR. And what's really great is, looking at this fund as an investor, we can show you the last 4 quarters of cash flow distributions we've been sending out. So as I mentioned, a big draw and something that sets us apart is immediate cash flow from day one. So quarters 1, 2, 3, and 4 of last year, we've been distributing at an 8% annualized rate. So there's an 8% preferred return structure, meaning investors are paid first at 8% per year. Anything above that can go towards return of capital. And then once all return of capital has been sent to investors, then all profits above that are split 70-30 in favor of investors. So I'm keeping the slide simple here. I can certainly share more details if you're interested afterwards about fee structure and split structure and pro formas and all the granular details. But we have a $75,000 minimum investment, and this is for accredited investors only. So a little snapshot as of January 31 of this year, we've acquired almost 1.5 million square feet of industrial real estate that's spread across 14 assets. We've brought in today, as of today, we're about 63 million in equity that we've raised. And we've had that funded and deployed the vast majority of that. As we're coming up towards the end of this fund deployment period, we're going to buy probably 2 or 3 more properties before we close this up. So this is open for investment. We're in kind of the final stretch. Now I'll pivot here to really talking about how this fits really well for an IRA account. So we structured MagCP Industrial Fund 2, but we also structured MagCP Industrial Fund 2 REIT. So this is an inline entity. And the reason we structure this is because it gets treated differently from a tax perspective. So investors have the choice. They can invest in Industrial Fund 2 Direct or Industrial Fund 2 REIT. Now, the Fund 2 Direct is the classic fund model. Investors are getting rental income from fund operations, and they get a K-1 tax form at the end of the year, and they get depreciation, which is passed through to them. Now, this is a great option if you're using after-tax dollars, not in a retirement fund. The MagCP Industrial Fund 2 REIT is a really ideal option for IRAs and solo 401ks, also for foreign investors, endowment investors, seeking dividend income. So what the REIT does is it takes rental income from Fund 2, and what it is distributing is dividend income. So it's sanitizing that in a way of sorts. So I wanted to put this chart up at the top here just to kind of show the differences between the two. Now, UBTI and UDFI taxes, you may be aware of, you may not be. Fund 2 direct, you could be subject to that if you're using a self-directed IRA. But Fund 2 REIT, you are not subject to that tax. So that's one of the number one benefits there, and I'll get back to that. Multi-state tax filing. If you get a K-1 tax form, you are going to have to file in certain states that the assets are held in. So it adds a little bit of a tax filing burden. And if you use a CPA, the cost could go up a little bit for tax preparation. So the REIT does not have that. You do not have multiple state tax filing. Fund 2 direct, again, you get depreciation losses. Fund 2 REIT, you do not. However, this is kind of a moot point when you're using a tax sheltered retirement account. You don't need that depreciation. You're already getting tax-free gains. So again, the tax form you get in the direct one is the K1. What you get in the Fund 2 REIT is this 1099-DIV for dividend tax form. Very simple. Again, does not require multiple states. And then again, as classification of income, Fund 2 direct is rental income, Fund 2 REIT is dividend income. So on the bottom here, you see unrelated debt finance income. This is a tax that the IRS puts on any retirement self-directed IRAs that invest in real estate that are using leverage, meaning a loan. And this is commonly used in real estate. So even if you bought a home, a single family home for rental with your self-directed IRA, if you're using a loan, you are now subject to this unrelated debt finance income. So the way the IRS looks at this is that you're using outside money to increase the returns of your retirement account. So it's not truly an entirely, the investment's not truly coming all from your retirement funds. You're using outside money. And the way they see that is apparently they think that's not fair, right? So in any case, we can avoid that here by using the Fund 2 REITs. So this is a really attractive option. And about 40% of the capital that we raised in Industrial Fund 2 has come through the REIT options. So it's been very popular, and the vast majority of that has been through self-directed IRAs. So I'll take a pause here and really actually wrap it up. I want to leave my contact information on the slide here, and then we can start to field some questions. My name is Drew Wahlgren. Again, I have my email and phone number here. So if this is something you want to learn more about or have questions and want to discuss, any other nuances, feel free to reach out to me after this. But I know we're going to open it up. Michael's going to MC some questions for us, and we'll take it from there.
Yeah. So, first thing, Lori asks in the chat, can an investor use non-IRA funds for this opportunity?
Yes, absolutely. Again, about 40% is coming through REIT 2, usually from IRAs, but we have a lot of investors who like to use after-tax dollars, and they go in Fund 2 direct most often because they want to access that depreciation. So the answer is yes. And to add to that, that depreciation, if you're using after-tax dollars, that's a really nice tailwind for you as you're investing out there. And what that means is usually in the first year, you're going to get 40 to 50% in depreciation that we're going to front load. We do cost segregation studies to get as much depreciation as possible in the first year. And so what that means is if you're getting making a $100,000 investment, let's just say, you get $45,000 in depreciation in the first year. Well, that first year, you might have gotten $8,000 in quarterly distributions, cash flow, right? 8%, $8,000 there. You're not going to pay taxes on any of that year. It's going to be offset by that depreciation, and you're going to have a net $37,000 in depreciation that carries over to the next year. And so the next year you might get $8,500, right? We're going to see this cash flow continue to increase over time as all these properties have built-in rent increases. So cash flow is increasing. By the end of 5 years, you're about 10% cash on your money. And again, continuously using that depreciation to defer your tax liability there. So it's a great option to go with Fund 2 direct with after-tax dollars. And if you're using a self-directed IRA with CAMA plan, you'd absolutely want to go with the Fund 2 REIT.
And as a follow-up, she asks, will that depreciation be recaptured down the road when the property sells?
Absolutely. So there's almost no free lunches with the IRS, but in this case, it is beneficial. It's always beneficial to defer that, right? To be able to use that distribution, excuse me, the cash flow from the investment and continue to reinvest that without needing to pay taxes on that each year. However, it does get recaptured at sale. So we're targeting a sale of the entire portfolio in about 5 years from now. So when that happens, the way the IRS looks at it is, hey, this didn't actually depreciate, right? Assuming we sell for a very nice profit, they'll say, okay, you actually need to pay back some taxes on this income that you got. You never pay tax on that. However, what's really beneficial is how it gets categorized, and this gets a little more complex, but I'll simplify it for you. It gets taxed at a rate of about 20 to 23% based on your income, right? So I'm kind of giving a range there. But it's a lot lower than a lot of people are getting taxed at, 30, 35, maybe 40%, depending on their income. So it's still beneficial even on the back end. And most investors take those proceeds at the exit of investment and they go invest in something else. Maybe it's Mad Capital Partners, Fund 5 at that point. Who knows? Whatever it is, but if it's an investment that kicks off a lot of depreciation, you can help offset that tax liability for the same year. So it's a little bit of continuously kicking the can down the road, so you're not paying taxes anytime soon.
Absolutely. And they say thank you. Um, Finally, I do have one question. How do you guys go about mitigating single tenant risk?
Yeah, good question. I touched on it a little bit, but really the front end due diligence is the biggest piece there. But to get into a little more detail, the way we look at these investment properties, um, we're looking at the tenants and their structure. Now, sometimes you do a deal with a tenant. Again, they're the seller and they're becoming your tenant in a sale leaseback transaction. And so we'll look heavily at their organization. And many times this is their single operating site. I'll give you an example. We closed on a property in Vermont with the company that manufactures gravestones, headstones, other artistic granite pieces. They're strategically located next to one of the North America's largest granite quarries. And this was their sole operating site. So if they ever, and by the way, the company's been around for 123 years in an industry where, unfortunately, we're all going to kick the bucket one day. And so
Yep.
there's a pretty consistent demand, and they've been in business for a very long time. But we like the fact that we're their only facility. Now, they do about $50 million a year in revenue. So this isn't a huge company. It's a privately held business, and they were bought by a private equity group who loves the business as well. So they bought the business. They wanted to sell the real estate and not tie up their money in the real estate. And for us, we go, look, if these guys get into trouble at any point in time, the real estate is so important to their operation, right? This is mission critical. There
Yeah.
might be other obligations that they have that they may start to sort of work out a payment plan on or something along that line, but they can't afford to lose this real estate because without it they don't have a company. So this is really operational and critical real estate for these businesses. And you got to look at downside scenarios, and we do all the time. We look at Chapter 11 potential, and Chapter 11 bankruptcy. You're able to reorganize under the protection of the bank and continue to operate as a company. Now, the bank will say, yes, you can, work through this debt with a lender. We'll write some of that off, or we'll convert some of that to equity. But when it comes to real estate, they can reject a lease, but only if they move out. And again, if I own their sole operating sites, they can't afford to reject the lease. Again, they don't have a company without this operating site. So that's a really critical piece there. So we look at that importantly. And now where that becomes even more interesting is when you look at an investment in a property that maybe with a tenant who has, let's say, a half a dozen operating sites. They have six. We're going to look at each one of those. We want to see how profitable each one, site level revenue, site level EBITDA, what's actually happening at this site, right? Is this an overflow storage warehouse? that's probably not a good piece of real estate to own if they get into a restructure situation. So we want to own their headquarters, the critical manufacturing operations, because if they ever do get in that kind of trouble, we're in great shape. This is a very too important for them to give up and not pay their rent. So you're very high up on the capital stack, or I should say, high up in their prioritization of expenses to be paid. So it's a strong position.
Yeah, that's a great answer. Thank you very much. Um, and
Sure.
with that, if anyone else has any questions, please feel free to throw them in the chat right now or in the Q&A. We'll get to them. But if not, Drew, thank you so much for your time. I certainly learned a lot today, and I'm sure that everyone here did as well. As a reminder to anyone viewing this, a recording of it will be sent out. And yeah, Drew, thank you so much for coming on today.
Thanks, Michael. Appreciate everyone watching and have a great day.
And I did, real quick, I got one more question. I don't know if that person wants to expand upon it. It just says track record question mark. So,
Yeah, no, that's great. No, I completely understand it. It's what's the track record of the sponsor? And, I invest as an LP with other sponsors. I actually use my own self-directed IRA account as well to invest out there and with different sponsors. And as they say, bet on the jockey, not as much on the horse. And the jockey here is Mad Capital Partners. So we've been around since 2015. So coming up on 10 years of this exact investment strategy that I outlined. So as far as track record goes, we've had 31 full cycle investments, meaning returned capital and profits. We've never lost investor capital. We've never had what's called a capital call where the sponsor says, hey, we need more money to save this investment so we don't lose money. Never had that. So we've had a pretty nice track record. And really, our investments, as you can see, they're structured for stability, right? This isn't something you're going to double your money in 12 months, right? This is a really steady, conservative investment that cash flows, a long-term lease in place, and it's firmly situated on the conservative end of the real estate risk spectrum. So again, I think the biggest risk that we've seen hitting real estate investors in the last year and a half or so is debt risk, right? What kind of debt structure do you have? Is it variable rate debt? Is it short-term bridge loans? Even if they're fixed, hey, after an 18-month bridge loan, usually those are floating, but I need to refinance or sell or something, and all those options look pretty bad over the last 12, 18 months. So for us, we've been really comfortable because everything we bought has used 5, 7, or 10-year term debt that's all fixed rate. So that's really helpful. So it's been, I never want to see anyone struggle with their real estate investments. But it's been really eye-opening for a lot of our investors as they look around and say, "Hey, I'm really glad I'm in a deal like this because you're sitting comfortable. I'm continuing to collect distributions, and there's no rough waters in the sea for us." So it's been a good run. The track record's been great, and as of today, we manage about $325 million in investor equity, which is primarily, as they say in the industry, high net worth individuals, meaning just individuals who are investing anywhere from, $75,000 to a couple hundred thousand. We have some big whales that invest with us as well, but our average check size in this fund is about 150,000. So it's certainly shows that we have a pretty large group of investors, and most of them are repeat. So anyway, happy to share more details on that if someone wants to reach out.
Awesome. Well, in that case, I think that's a good spot to end it. So once again, Drew, thank you so much for coming on today.
Thanks, Michael. Appreciate it.
Have a good one, everyone.